Good afternoon, everyone. My name is Luke Tannen, and I'm the Executive Director of Chicago Innovation, an organization that supports local innovators across industries, big companies and startups through a variety of events and programs. We're also a very proud partner and customer of Wintrust. And on behalf of Wintrust, I'd like to welcome you all to the fourth installment of Wintrust Wealth Management's panel discussion series on the economy and financial markets. Today's event, Inflation, Congress, and the Fed, will address the threat of rising inflation in the context of efforts to boost the economy during the pandemic and what it may mean for the future. Our moderator for today's discussion is Tom Zadar. Tom serves as chairman and CEO of Wintrust Wealth Management, which manages or administers $34 billion in client assets across 4 operating business units: asset management, trust, investments, and 1031 exchange. Our panelists today are Ed Waymer, Jason Turner, and Dan Rahill. Ed is the founder of Wintrust Financial Corporation and serves as the company's chief executive officer. Since 1991, under Ed's leadership, Wintrust has grown into a financial holding company with over $46 billion in assets, operating 15 community bank subsidiaries with over 170 banking locations located in the greater Chicago and southern Wisconsin market areas. Wintrust also offers commercial banking and treasury management services, commercial and life insurance premium financing, mortgages, 1031 tax-deferred exchanges, and wealth management services. Ed is a certified public accountant and earlier in his career spent 7 years with the accounting firm Ernst & Young, specializing in the banking field, particularly in the area of bank mergers and acquisitions. Jason Turner serves as the head of multi-asset strategy for Wintrust Wealth Management's asset management organization and is a member of its investment committee. He's primarily focused on interpreting economic and market conditions to create investment solutions and strategies for institutional and individual client portfolios. Jason's a regular guest on WGN's Business Lunch Hour radio program and does frequent public speaking engagements on the markets and economy. And finally, we've got Dan Rahill, who serves as managing director and resident tax expert for Wintrust Wealth Management. He's often published and quoted in media outlets, including Chicago Tribune, Crane Chicago Business, ABC7 TV, and Yahoo Finance, as well as the Illinois CPA Society's Insight magazine. Dan is a former chairman of the Illinois CPA Society and serves on 3 academic advisory boards and several nonprofit boards and committees. With that, it is my pleasure to turn things over to Tom.
Great, thank you, Luke, and welcome Jason, Ed, Dan to our talk this afternoon. And we're going to jump right into it. Because today we're going to talk about the economic recovery, spending plans in Washington, and the rising threat of inflation. So we'll start with inflation. After years of largely being an afterthought, inflation has been front and center in the news lately. So a quick refresher we thought would be in reorder for us to get this conversation started. So Jason, I'm going to start with you. Would you mind giving us a brief summary of how inflation affects the economy, the markets, and our own pocketbooks?
Well, the easiest and most straightforward explanation of how inflation affects us is as rising prices go up, purchasing power goes down for the consumer. So higher prices, less purchasing power. That encourages individuals to spend today or invest today as opposed to holding cash because the future value of cash in real terms is lower. For businesses, it can actually encourage some increase in employment as the relative cost of labor decreases as prices go up. Important to note, some level of hyperinflation is always the concern that inflation is going to build on top of itself. Think Weimar Germany, think Peru in the 80s, or Venezuela most recently in the 2010s. But it's also important to note some level of inflation is important and needed for growth. It's the backbone of a bit of the growth assumptions, and 2 to 3% would be the sweet spot.
Excellent. And Jason, there are a number of ways to measure inflation. So again, if you can educate us a bit, CPI, PCE are commonly referenced, and there's core and headline versions. So can you tell us which is the most worth watching?
Sure, you pick up an alphabet soup of different
right.
identifiers, but most often quoted is CPI, or Consumer Price Index. That is the reference point for Social Security, for a number of financial contracts.
Right.
That is most often quoted, but not used by the Fed any longer. The Fed uses PCE, or personal consumption expenditures. It's an element of the GDP report. It tends to be a broader measure. There are some key differences, and I think we have a slide to show us what CPI looks like. There's 8 key categories to CPI. Those 8 categories are weighted according to a survey of consumers. So consumers say how they're spending their money, and they're not adjusted for replacement cost. So if something gets really expensive and consumers prefer to purchase a different good, the baskets are not readjusted.
Right.
On the flip side, the Fed's preferred measure, personal consumption expenditures, or PCE, is a broader basket of categories, for one. Secondly, it is reweighted based on a survey of business sales as opposed to a consumer opinion. It's actual business sales. And it is reweighted for replacement goods. So the Fed prefers that broader measure that's a little more encompassing in the economy.
And Jason, headline versus core, can you just define that for us real quick?
Headline versus core is two volatile categories, energy and food. So they're included in the headline number. They're excluded from the core number because on a month-to-month or even week-to-week basis, as we've seen recently with the price of oil, energy and food can move around quite a bit.
Which isn't right, because you take booze and golf balls and my car and my life, that's all my spending.
And we know that's all going up too.
Yeah.
Right? Jason, you mentioned the Fed. One of the primary charges of the Fed is to manage the U.S. money supply through monetary policy to regulate inflation. So what tools does the Fed have at its disposal to do that job?
At a basic level, it's three key tools. It's changing the federal funds rate, the rate at which they are going to lend. It's changing reserve requirements for banks to increase or decrease money supply. And then the third one is open market activities, what we've seen the Fed doing month to month with these $120 billion of bond purchases.
Got it. And let's talk about inflation and where we stand today. So the Fed has stated at 2% as its long-term inflation target. Where is PCE today, Jason?
We just got our latest update on PCE at the end of last week with the GDP report. It was up 3.5% on a year-over-year basis, but just shy of analyst expectations for a 3.6% increase. The areas that were kind of surprises to the upside were consumer spending and personal incomes. Both were up strongly in the report.
Got it. And we just showed a slide of that. So, Jason, the inflation numbers are really, historically not that high, but they're at their highest level in more than a decade. And some have noted these numbers may be overstated due to base effects. So, what are base effects, and how much of this increase we've seen lately can base effects actually account for?
Base effects, real simply defined, we're comparing price levels today to price levels 12 months ago with those year-over-year changes. And if we remember what the world was like 12 months ago, particularly in April and May and somewhat in June, we had the economy locked down because of COVID, and those point in comparisons are what the Fed refers to as base effects, meaning we're comparing a low base of prices to a higher base of prices today.
Got it. And so one of the criticisms of late of the inflation metrics that our national readings don't necessarily reflect what's happening locally or regionally. So Ed, I'm going to turn to you on this one. What are we seeing in our markets in terms of inflation?
Oh, inflation is up for sure. It's the Fed keeps saying it's transient. Does that mean that you guys are gonna give those raises they just gave you back? These cost of living deals?
Do you get a raise?
I didn't get a raise. Did you get a raise?
Yeah, right. We're having getting labor is much more expensive across the board. The rise of minimum wages, what the government's paying to not work. That's really something that we're all dealing with, is getting labor and making it work. It's not going well right now, as you know. There's more jobs outstanding than there are people right now, I think. We got to get people back to work. It's gonna be much more expensive to do that, which is really wages will be the real, and people are gonna have to recover those wages. That is the core of the problem.
Yeah.
So what I'm seeing is our customers and clients are having trouble getting help, having to pay up, which means prices are gonna go up to cover that.
Yeah, and we'll hold the transitory debate for a moment, but Jason, to Ed's point, what else are you seeing driving this sort of recent uptick in inflation?
Well, Ed brought up the idea of transitory, and the Fed kind of lumps base effects in there, but they also lump in some of these supply demand imbalances. Ed already mentioned the labor shortages and the like. We've also seen some serious changes in demand and supply since the pandemic restrictions have been lifted. A number of supply chain issues that were actually building through the trade conflict with China up and exacerbated by the COVID situation. And now that consumers feel like they can spend, and have extra money in their pockets, they're out in force in the economy. We've seen some outrageous retail sales prints in prior months.
Wasn't the definition always too much money chasing too few goods and services
Exactly.
causes inflation?
And you got both going on right now in a big way. Did we show that slide? I think there's some pretty interesting categories that, and you guys can't see it, but rental cars, gasoline, used vehicles, airfare, transportation, all over 20% growth, Jason. I mean,
Yeah.
so
Over
big,
20% inflation in all of those areas. And they're all similar stories to what Ed and I have already laid out, but very different. Airfare, it's people deciding to go back, either business travel or leisure travel. Used cars is a replacement. We've seen these massive chip shortages. Drive past any new car lot and look how empty they are right now. People are shifting their preference to used cars. That's actually probably less economic growth than a new car, because even with the price increases, used cars are still cheaper than new ones.
Well, let's turn to the audience on that, see what they're feeling from with respect to inflation. So, guys, if you could pull up that polling question. And our question is, what level of inflationary pressures have you experienced in your business or personal expenses this year? So we'd ask you that there's 4 different options. We'd ask you to click one of those, I guess there's circles on there. And the first one is, have you've noticed or not noticed or been affected by price increases? You notice slight increases in a few areas, notice significant increases, but only in a few areas, or notice significant price increases in multiple areas. So if you take a moment to respond to those, we have a feeling we know what you might say, but we'll see what the polling question answer is. So while we wait for the audience, Ed, I'm going to go back to you and just ask you to look out 12 to 18 months. And what is your outlook with respect to inflation?
I think inflation's here to stay. And, if you think about it, how did they get out of it? How can the Fed is really all the things you talked about, they used them all.
Right.
Look at the Fed balance sheet since the Great Recession, going from $1 trillion to $9 trillion. $9 trillion. It's all mismatched. Borrow short, lending long. They turn over about $100 billion to the Treasury every year in terms of the spread they make on that. If rates go up, that's going to kill them, because the Fed, they could get upside down on those. And they get upside down, rates go up, our huge national debt, which is approaching what now? How much? 27 trillion?
7 trillion. Yeah.
1 point on that's a lot of money. It could be a disaster. I don't know how they're getting out of this thing. They think they can control both sides. And they were lucky because the rest of the world is in worse shape than we are.
That's right. That's right.
But the fact is that I don't know how long they can keep these rates low, because it's them keeping it low by doing the securities, mortgage buying and the like.
Just every month, right?
They are keeping the rates low.
So right on that question, Ed, what, they are, the 10 years at 117 today. So incredibly low. When do you think that change happens? And what's the trigger?
I thought it would have happened by now. We did what the Fed was doing. We had a cease and desist a long time ago on the interest rate sensitivity side of things. They get upside down really quick. If markets were to go to find their own level without them interfering right now, I think your 10-year would be closer to 3%. I think 10 years will probably settle in the next 3 or 4 years, depending on how long they want to keep this up, at about 4%, which that's a lot.
Yeah, a lot different from today, for sure. Jason, what's your take on rates in the next 12 to 18 months and inflation finally? We will get to the transitory in a second, but what do you foresee?
Yeah, I think some of the base effects sort of drift out of the numbers over the next several months. Obviously, the fall of last year was a much better situation than the spring, economically speaking. So some of those base effects go away. Think of Warren Buffett's quote, with the tide going out, really revealing who's swimming naked, right? We'll get the base effects out of the way. We'll get some of these transitory things out of the way. And then we'll see the areas of the economy where that inflation is actually persistent. My base case would be inflation trails off a little bit from its current level over the next 12 months, but still stays elevated. Long term, it's really fighting some serious demographic headwinds, getting back towards a lower number, but that's more in Ed's 3 or 4 year outlook than the next 12 months.
Well, and I'm going to pull Dan into this. You've been patient over here, Dan. We've been talking about sort of monetary items, but proposed federal spending plans could also, well, and past spending plans, but the ones on the table could really further drive inflationary pressures. Where do you see inflation going over the next year or so in light of what you know about Washington?
Well, based on what everybody said, the disruption in the pipeline of goods and services and the disruption in wages, there's obviously a recalibration in labor that's coming out of COVID. And the third thing is the Delta variant. While it's not going to have the same impact, obviously, as we went through in 2020, will it have any sort of impact globally on supply chain and manufacturing? So for the next year, I agree totally with Ed and Jason that inflation is here. Thank God you're not asking me for beyond the next year, but definitely the next year, we're going to be going through it for those three reasons.
Yeah, agreed.
Higher taxes going to add to it too. You have higher taxes going to pay for all the stuff they're doing. That's going to have a big effect also. Corporate taxes go up, we're going to want to make more money, we're going to raise our fees and what have you.
It's coming from a lot of directions, supply
It
and
is.
demand. All right, let's go back to the audience and see what they felt about inflation and get our polling results. So I'll read it for you. It looks like with 37 and 38%, the two categories that are the largest have noticed significant price increases in many areas, which we've just talked about, or have noticed significant increases, but only in a few areas. So that's 75% of the audience in those two answers. So they're seeing it just like we're seeing it, which makes sense. Well, we've touched on the prospect of further federal spending just a second ago, Dan. And where are things right now in Washington? We heard this last week about the infrastructure spending package. Can you give us an update there?
Right. Well, you've heard a lot of numbers bandied about the last month. You've heard 1.2 trillion over 8 years. You've heard 1 trillion over 5 years. I think the number to really focus on is the incremental spending over what they were already going to spend, which is $550 billion over a 5-year period. And that's really been whittled down and I'm just going to read some of the categories: roads, bridges, expanded broadband, expanded power grid, climate agenda a little bit, but not much that didn't make it into this bill. Everything that was talked about a few months ago about that spend, that's going to overflow into future legislation that we'll talk about, a $3.5 trillion package that's on the heels of this one. But with regard to this, there's really no real tax increases in this plan. It's been paid for in some very creative ways, and I think we have an upcoming slide that's going to show that.
Okay, well, where is this one? And just to be clear, there's been a lot talked about. This infrastructure bill really looks like infrastructure. It's roads and
Right.
bridges and the like.
Right.
But as you said, there's this $550 billion is really the incremental spend.
Mm-hmm.
So the sort of the creative sources to fund that, I think we've got a slide. Can you speak to those?
Sure. So the funding, and I've got it in my pocket, a really interesting article that we talked about before we went on air, the pay-fors that aren't, in today's Wall Street Journal. I think that was really interesting because there's been some real creative accounting that's gone on by the senators that put this bill together. You can see in the graph that goes up on where this is being paid for. $200 billion is being repurposed from original coronavirus relief. But some of the interesting pay-fors: unused unemployment insurance supplemental benefits. Recall, over 20 states with Republican governors decided not to accept the $300 per week of unemployment supplemental insurance from the federal government. So that's $50 billion that remains to be unspent. Some Medicare rebates that have been deferred from the Trump era rule, that's another $50 billion. And then $60 billion coming from economic growth spurred by additional spending that will be created by the infrastructure bill itself, sort of a circular equation. So it's interesting how they've scored this thing. One thing I want to point out to our Wintrust friends, clients, prospects, is something that hasn't been brought out much that they're probably taking advantage of, small business owners, and that's something called the Employee Retention Tax Credit. You get $7,000 per employee per quarter, and on that credit against your payroll taxes for companies up to 500 employees. And I want to point out that in reading the bill this morning, they cut that out after September 30th. So that would impact many small businesses. Businesses with under 500 employees are going to be impacted by that. They're taking that back, feeling that the coronavirus relief is no longer really needed. And they may be right on that.
Got it. Well, so Dan, that you alluded to this already. So there's $1 trillion infrastructure proposal that's it's likely, it sounds like, going to be passing in some form here. The follow-on is this $3.5 trillion bill that is, they call human infrastructure.
Right.
So can you talk about what that is and what it's intended to do?
Well, this is where it's going to get really interesting. Everything that didn't make it into the bipartisan infrastructure bill is now being lumped in by the Democrats into this $3.5 trillion proposal that they are rolling into the annual budget. So recall from our prior quarterly discussions, we talked about the federal government's on a September 30 year end. Once a year, they go through and propose an annual budget. The budget that's being proposed by the White House right now is $6 trillion, an enormous budget, which includes an additional $3.5 trillion of spending of Democratic platform proposals that didn't make it into the infrastructure bipartisan program. Things like family and medical leave, subsidized childcare, the expanded childcare tax credit, which people started receiving just a few weeks ago, universal pre-kindergarten for 3- and 4-year-olds, affordable housing, and broadened Medicare benefits, including dental, vision, and hearing as part of Medicare now. So all that spending is going to roll in and is part of the $3.5 trillion proposal right now that, quite frankly, I think has zero chance of passing in any form the way it is currently. But is there a real chance that something's going to pass? Yes, there is. Yes, there is. There's a real chance that something would be agreed to by Senator Joe Manchin of West Virginia and Kristen Sinema from Arizona and others, that if they can bring that number way down, a second package on human infrastructure could make its way through by the end of the year.
Because again, it's a budget reconciliation process, so you don't need the 60 votes. It just needs to be a majority.
Right. We talked about that in our prior quarterly talks too. Yep. They would only need 50 votes if they were able to use what I think of as a budget umbrella. You've got an annual budget. They're going to pass the annual budget, and then they're going to work not 3.5 trillion, but in theory, some number under that annual budget. And that's exactly the way President Trump passed his 2017 Jobs Cuts and Tax Act. That also was passed by reconciliation with just 50 votes in the Senate.
Yeah, okay. And just timing wise, you mentioned the fiscal year end. So what do you expect here as we look ahead in August, September, and then through year end?
Well, this way, the Senate's supposed to go on August recess next Monday. Chuck Schumer has said that will most likely be delayed. He's going to hold them back, and he wants to vote on the bipartisan $1 trillion infrastructure bill in the next week or two. There's been a lot of pushback from Republican senators saying it's 2,702 pages. We haven't read it yet. We don't know what's in here. 2,700 pages. We need more time. We'd like to push that till after the August recess into September. So it's a wild card right now as to whether, if it doesn't pass in the next 10 days or so, if he does push back August recess by a week, Schumer does, they do pass the bill. Once it passes the Senate, it goes over to the House of Representatives. And this is where it gets dicey, because Nancy Pelosi, and we've all seen it, has said she's not going to take up the $1 trillion infrastructure package until she gets her $3.5 trillion human infrastructure package. So there's a lot of posturing going on right now. Bottom line, end of the year, end of the calendar year, if something passes.
Got it. So thanks, Dan. A lot going on. And thanks, by the way, for sending me that 2,700 page document that crushed my email the other day. Pass that on.
Through it?
No, I did not. I'm not sure any of the senators have gotten through it either, but all right, but thank you, Dan. So still a lot of government spending being contemplated, coming on the heels of nearly $5 trillion in spend to combat the virus and the pandemic as a result thereof. So Ed, I'll go back to you. Considering the fiscal stimulus efforts like PPP, and that program and the unemployment benefits and some of the Fed's monetary moves, how do you think policymakers in Washington have done addressing the economic slowdown triggered by the pandemic?
For the first time, I think they did a wonderful job. PPP program was really well done, took all the red tape out. Hats off to, I think it's Mnuchin who, and the Treasury Department that pushed it through. SBA that didn't know what they were doing. It's kind of funny. They'd have a, say by 6 o'clock tonight, you're gonna have the stuff. By 5:55, you'd get it, it'd be all Treasury. You know, you could see the Treasury had written it, but they did, the SBA stepped up, is doing a great job. No strain, you know, there would be some hair on it, but he didn't get chastised for doing it. Everybody's, oh, we don't want to do it because we did it last time, we got the crap kicked out of us. Well, this time it worked really well. We were able to get the money out, they used the banks, we got the money out quickly. That saved a lot of businesses and a lot of jobs. I think they did a wonderful job on that. A lot of comparisons to TARP. I remember they made money on TARP.
That's right.
They made money on the banks, they lost money on the auto companies and Freddie and Ginnie and Fannie and those guys.
Yep.
They made money on that all in. This is money out the door. It's a permanent part of the deficit. Back to the inflation side of things, they have to have inflation to eventually pay it off. We're gonna have some sort of inflation to pay this off. And that's what I think they're hoping for. It's the only way out of the bucket.
Yeah, and so well said. And by the way, Ed, maybe you want to quick plug for the PPP program. Was how many thousands of borrowers did we assist in that process?
We did probably $3.8 billion in that paper. Average ticket size was close to what, $19,000. So thousands of jobs were saved. It really went well.
Yeah.
I'm sorry. 79,000. I'm thinking different. It was 80,000 bucks.
Yep.
The average ticket
But it
size.
shows you small businesses were helped a ton.
Oh, yeah.
Especially by us.
Yeah, and we went out, I couldn't be proud of our people. We went out of our way to get that done. We had, in low to moderate income communities, we had, we set up workshops with computers at work. They come in, we tell them, couldn't do it. We could walk them through it. A lot of low to moderate income and not-for-profits benefited from that and are still in business. So they really did a wonderful job of that. And our staff did a great, people get emails from our staff at 3 and 4 in the morning, and not because it was for the bank, it was because they knew they were helping people sleep better.
It was
Could have been prouder of them.
great effort by everybody. It was incredible. But Jason, Ed just hit it on, these federal spending programs can be inflationary. And so now we can talk a bit about the Fed's stance and their positioning as to inflation. So I'd love to hear your perspective on that.
Yeah, so not can be, they are inflationary. You inject this many trillions of dollars. I think Ed said it earlier, that you look at the size of the Fed's balance sheet, it's grown from 850 billion before the 08-09 financial crisis to $9 trillion today.
Yeah.
The first 4 trillion were the global financial crisis. That took almost 6 years to deploy. They deployed the next $4 trillion in 3 months.
Yeah.
It's astounding. So with that much money injected into the financial system, you're going to have inflation. What the Fed is contending is that this is transitory, and they've been pretty consistent in that narrative. You look at Chair Powell's comments, you look at another Fed governor's comments, you look at the minutes of the Fed meeting. Even though there's a little more squabbling in the last July meeting minutes, they're still pretty consistent that it's transitory. It's base effects, and some of these supply and demand imbalances, they're going to right themselves over time.
Not even close.
Yeah, well, so that, I mean, again, their position is it's transitory. Ed already raised the point that, it's not gonna be easy to give salary increases back, and there's some inflation that's going to perpetuate. Ed, in light of your comments, what's your advice? What should the Fed be doing and when?
Boy, that's a good question, because you're kind of deep into it now. I think they've got to start slowing down, let market rates go up a little bit, and just see where it shakes out a little bit. Although rates drop, I figure the refi boom was over, rates dropped. We had a record week last week in terms of new apps. Hard to believe, but a lot of people haven't refinanced yet. I don't know what they can do, to be honest with you, because they're so deep into it right now. They've got to, when they taper, they're gonna sell too, because I think the duration on the assets they picked up are a lot longer than they used to be because of the rates they've got. People aren't gonna move as much as they used to. Used to move in 5 or 6 years. We got a new loan. These are 1-2% loans, 30-year loans.
It's pretty
People are
attractive.
gonna be in their house forever, I think.
I think that's a great point, Ed. We saw it out of 08, 09, when rates were really depressed in the mortgage market. Mobility really fell significantly. People stopped selling their homes. You talked about all of the housing stock that should have been built in the last decade that wasn't built. A lot of it's been built in the last year, and a nice increase in new home building. But we went a decade with mobility low, where baby boomers weren't selling their houses when they retired. They're staying there because they paid them off, or they got a nice cheap loan to refinance it.
Well, and remote work adds to that.
Oh,
as
yeah.
well, right?
Remote work is, that's a new phenomenon we gotta deal with.
Well, excellent points, guys. So let's turn and look a little bit to the future, and we'll go back to the audience and see what see how they predict rates going forward. So our second polling question to the audience is: the 10-year Treasury is currently, as of today, 1.17%, 117 basis points. It's a staggeringly low number. Where do you expect it to be at the end of the year? And we've got 5 buckets for that: less than 1%, 1 to 1.5%, 1.5 to 2, 2 to 2.5, or greater than 2.5%. If you guys could take a moment to respond in the audience, that would be great. We'll love to see where you predict it to be. I think I know the answer from Ed, but Ed, where do you expect to see the 10-year in, let's say 12 months rather than the end of the year?
Unfortunately, I don't think it's gonna move that much. It'll be about 170. I think 170 be a good number. 175,
So 60 basis points higher than where we are, something like
Yeah.
that.
which is really where it was 2 months ago.
Yeah, not too much. Right. That's right.
So the Fed keeps buying everything, and there's, they control both sides. What are you gonna do?
Let's do we have the results back? I'd love to see how that compares to Ed's number. Okay, pretty similar, Ed. So we have very few people at the tails of the histogram here. We've got 43% a tie, 43% 1 to 1.5, and 43% 1.5 to 2, and a little bit 9% 2 to 2.5. So most people are with you on this. Jason, what's your take?
So that's interesting, because the last time we did one of these, we asked a similar question, and we saw nearly the majority in the 2 to 2.5% range.
Not too long ago.
How strange things have changed when rates have fallen. We saw it stuck in this trading range, 145 to 175 for a long time over the course of the last several months, and now all of a sudden the bottom's fallen out. That generally telegraphs that the bond market thinks that growth is not going to be as strong in the next 6 to 12 months than we had expected it was going to be 2 or 3 months ago. Some of that is reflected in the GDP print we just saw. Underwhelming from a consensus estimates perspective, but some of it, plays into some of these things we've been talking about. The Fed is absolutely walking a tightrope here, and they could very easily act too quickly or too heavy-handed and really kneecap growth here in the United States. They could also let this run too long, and that really disadvantages low and middle income Americans. It really damages all of the American consumer and most of the small businesses out there too, because those prices run much longer than expected in terms of inflation, and they're not going to have the growth in the out years to really support it.
How much benefit do you think they're getting from the negative rates in the rest of the developed world?
I don't know if there's much benefit to the negative rates, to be honest. I think they're stuck. They stuck themselves in that situation in 2009, and Europe grows slower than we do. So to support their
but the
growth,
money
they're gonna
coming in
stop.
is gonna be huge.
Absolutely, and
Sure.
that's going to depress our rates. I mean, so it's sort of
Yeah.
relative, growth prospects as well as rates. That's the other thing that's dampening the current rate scenario. So I would agree with you on that, Ed.
This new economic, Keynes is rolling over his grave right now. He never thought that they would take it and have the Fed, the national banks, like the Fed, take both sides of this and really goose themselves up like that. That's not what they're supposed to do, and they've done it anyhow.
Keynes is rolling over in his grave. Hayek is absolutely doing backflips from the Austrian perspective. It's a little nuts.
So Dan, let me bring you into this discussion, because we talked about spending, and that should, if we do see, I don't know that we will. I'd be curious to see what you actually think will get passed, knowing what you know about the makeup of Congress today and how inflationary that is, we've talked about, but what's your best prediction as to what gets through with respect to this $3.5 trillion proposal and when?
Well, Ed mentioned early on that an increase in taxes can also fuel inflation. So, and I totally agree with that. The first thing I think is going to happen is some version of infrastructure will pass. We've got 66, 67 senators lined up there. Nancy Pelosi will probably back off her hard stand. And we want
Coupling the two together.
coupling the two together, and that will pass in the fourth quarter of this year. But again, there's no
Rip it up.
well, that's the infrastructure piece. Now, the 3.5 trillion, they would have to get Manchin and Siema and every Democrat on board, all 50 of them. Manchin's already come out and said many times he wouldn't vote for corporate income tax rate going more than 25% from today's 21. The Biden administration proposed 28. He would not go above 28% on capital gains. And the Biden administration had and Nancy Pelosi's proposals 39.6, the top individual tax rate. So I do see that if something does pass by the end of the year, and I'll go right down the end of the year on the social infrastructure, it would be perhaps capital gains up to 26 or 28%. For ordinary rates, yes, they will go back to where they are going to go in 2026 anyway, when the Trump Jobs Cuts and Tax Act expires, and that will happen. And I could see all 50 Democrats going for those small changes, but not these huge changes that are being proposed right now. I do not see the step up in basis on a state when someone dies going away, paying capital gains on that. There's not going to be any retroactivity that was proposed in the Blue Book a few months ago on capital gains being stepped up. That won't happen. It would be effective most likely January 1, 2022, and there would be modest income tax increases, not the big ones that are being proposed right now. And I will say, finally, Tom, one thing is for sure, the Jobs Cuts and Tax Act tax cuts from 2017 will expire after 2025. Bonus depreciation for corporations is going to start phasing out in 2023.
Everybody stopped doing it anyhow.
Yeah, I mean, that's going to go away
Well,
anyway.
in anticipation of higher rates, we're not doing it.
Right. It's going to go away. That's going to go away. Higher rates are coming, which would increase the value of future depreciation deductions, right, at a higher rate. And the individual tax rate will go up to 39.6. And the lifetime, one plug for estate planning. A lot of our clients and friends have been doing estate and gift tax planning. The lifetime exemption, which is currently 11.7 million, will for sure get cut in half in 2026, if not before. But right now, that's for sure. That's going to get cut in half because Trump doubled it. That expires in 2025, and it's going to come back down. So that's for sure. So that's another tax increase on estates and assets being passed from one generation to the next.
Do you think they'll bring the salt back?
That's a really tough one.
State local tax deduction.
Right. The state and local tax deduction. I know that California, New York, and certain lobbyists in Illinois are pushing hard for that. The cost is just going to be huge. Against the pay for is really huge there. But I could see some movement on that. Not an unlimited again, but there've been talk about some movement on that. The Democrats are going to push hard on this $3.5 trillion, and the SALT's going to be part of that from the very progressive wing. They're going to push on a lot of things. And then the centrists, like Joe Manchin and Kristen Sinema and others, are going to push back and say, no, we can't go that far. No, we're not going to do this. And Manchin, coming from West Virginia, which is a traditional, historically coal state, has been pushing back on the renewable energy proposals that have been put forth. So it's going to be interesting to see the horse trading in the fourth quarter. I think there's going to be a lot of new proposals and a lot of things. And I think anything that does get passed is going to be really watered down from what.
And likely smaller is what.
And smaller. But I do think a version of infrastructure will pass. I think that makes sense. I think everybody agrees on that. Timing, we don't know, but.
On the estate tax thing, don't you think they should I mean, it's one size fits all. Some have 6 kids like I have. Shouldn't you have amount per kid? I mean,
Now you just get you and your wife, so you get 23.4 today. What can you do?
Well, good stuff, Dan. So I'm going to go back to you, Jason, listening to Dan. I mean, there's uncertainty abound, in Washington with the economy, with inflation. We always look back to you as to, guidance and counsel to our investors in the audience. What is your advice to them as they look through the end of the year and in the next, let's say 12 to 18 months?
Sure. And you heard it in all of our comments. There's quite a bit of uncertainty, whether it's uncertainty around the size or timing of 2 infrastructure bills. It's uncertainty around the direction of inflation. In periods of uncertainty, volatility is going to be higher. And we've certainly seen market volatility creep up over the last several months, both in the bond and stock markets. That week-to-week volatility probably persists through the second half of this year. There's very little certainty in the direction of markets. Markets like certainty, and without it, we'll have that volatility. Your best tool to combat a volatile and slightly uncertain market is diversification. A diversified portfolio really makes sense right here. And that's diversified across geographies, it's diversified across asset types, and it's diversified across stock types too, growth versus value, for example.
I was doing some research on my own, believe it or not. Hard to believe.
Yeah.
I was looking up. What investment class did best in high inflationary markets? It's small caps. Believe it or not.
A lot of domestic focus, which has been helpful.
Domestic focus, and with small caps, you're also talking about high inflationary environments usually occur during recovery phases. So when you're recovering in the economy, when the economy is growing fast, those smaller companies realize that growth a lot faster. So they see it on the bottom line faster than, say, a large cap like a Walmart or something.
How about hard assets?
Commodities have certainly seen quite a run. When we look at that, what we call a real assets category, we include commodities, infrastructure, and real estate. And in the last quarter or so, real estate's really jumped as we started to see a way out for commercial real estate, especially. There was this fear last year, and the reason real estate trailed is a lot of people thought people would never come back to the office. And now there's kind of a drumbeat of hybrid is kind of the new normal. And we're going to need office space, and we're going to need people together. And that's helped the real estate market. But infrastructure spending will certainly help the infrastructure side of that too.
Ed, what do you have a unique view looking and talking to our commercial customers in light of this backdrop and everything we've talked about. What's your counsel as they plan their businesses for the year or 18 months ahead?
Keep a fortress balance sheet at all costs. You should always do that now. Don't over leverage. You don't know what's coming. You can't over leverage. You got to be smart and take what the market gives you. Don't think you're smarter than the market. That's what I tell our guys. Just stick to your knitting. You've got to get labor. You got to keep them. It's going to be more expensive. Try to get your price increases through. But just keep your head down and don't think you're smarter than the market.
And find a good banking partner to help you along the way.
That goes without saying.
Without saying. No, good counsel. Dan, any last comments from you as you think about? I mean, it's interesting. Even if nothing happens, a number of these sort of Trump era tax changes just expire.
They're on their way. So that's the one for certain here.
Yeah.
Is 2026. Depreciation will start phasing out before that. So a lot of those tax cuts are going to go away in 2026.
You sure though? You could have a new regime in. You could have anything could happen. I mean,
right in 2024, we could get a Republican president, and everything could flip, and they could go back to square one and extend some of those.
Depends how long this mess goes on. I mean, it's kind of like watching a movie. You know how I think I know how it's going to end, but you get closer to the end, you could have a flip in Washington because people are kind of tired of what's going on here.
Yeah, I think from a state standpoint, what you're saying though is be prepared. You'd rather be safe or ahead of this than to wait and see it go away.
Right. What I would say is plan now. Plan now. You're gonna need to do it anyway in the next few years. So do it now on the chance that this timeline could be accelerated as well. It could be accelerated. We don't know, but for sure the estate and gift tax lifetime exemption will go from 11.7 and get cut in half in 2026. even under even if a Republican administration took over in 2024 with the deficit and all the swimming against the stream here that we see, it's up in the air as to what's going to happen.
I'll put a commercial in. With rates as low as they are, many of our clients are looking at our life insurance finance business, which you borrow at a very low rate, and you get a second die policy or a first die policy if you want, but it's very affordable. The returns are awesome because what you earn on the life insurance is not taxable. So it's very beneficial product. If you don't know about it, give our guys a call. They'll tell you about it. But I just took one on myself, and I'm afraid to turn around with my wife looking at me all the time. Food taster and everything. I don't know what to do.
Yeah, that's our life insurance premium finance business. So we're happy to talk to anybody about that. But good point. Great point, Ed. Okay, so we're bumping up a little bit past our time, so I'm going to wrap things up. But I want to thank Jason and Ed and Dan for your time, and everybody certainly on the phone and video. Thank you for joining us. As previously noted, we'll be conducting these panel discussions every quarter. So our next one, we're going to try to do it in late October, early November. In the meantime, you can follow Jason's thinking on the economy by reading his weekly market update. That's either on our Wintrust Wealth Management website or on LinkedIn, or you can get it from your relationship banker or advisor. Send you an email. Any way you want it, we'll get it to you. Dan publishes articles on legislative changes, and he's done a number of these over the past year. And as things change, he'll keep updating them and bringing.
I need to do one on life insurance, premium
true.
leverage life insurance. We got to get one of those out.
That's true.
It is a great planning idea.
But look under the guidance section of wintrustwealth.com for Dan's articles. And then finally, a recording of today's event will be available on Wintrust YouTube channel, as well as a transcript will be out there on our website. So we thank you all for tuning in. Stay safe and enjoy the rest of your summer. Thanks, guys.
Thank
Thank you.
Thanks.